In this video, we're going to conclude our discussion of return and risk by looking at the second part of this, which is the risk issue. So what is risk, right? There's uncertainty in all financial decisions. In fact, there's uncertainty with all decisions in general. So there's always some risk element. But if we want to quantify this number, we want to be able to attach some value to the risk, we have to have a slightly different formula. So risk is the chance that the actual return from an investment may be different from what is expected. And there is a risk-return trade-off. The relationship between risk and return for investors is when they want to obtain the highest possible return for the level of risk that they're willing to take. Now, this doesn't say it has to be the lowest amount of risk. It's whatever amount of risk you want to take. So what are some of the sources of risk? And yeah, I'm not going to go through each and every single one of these, but all of these elements, if you will, come together to form the value or the quantifiable value of risk in an investment or a financial decision. There is business risk. Business risk is created obviously by the kind of business, not just the kind of business, but the industry, how it's managed, the location of where it's located, right? But all of those things that are part of running the enterprise is considered business risk. Financial risk has to do with how that business is financed. But we have lots of other forms of risk, and we'll talk about these throughout later videos. There's purchasing power risk. This talks about the impact of inflation. There's interest rate risk, liquidity risk. If you buy an investment, you certainly want to be able to sell the investment when you want to. There's certainly tax risks as the government changes the tax code from time to time. Event risks. This is really more of a company kind of a risk, but there are events in the economy that will have an impact on the returns of investments. Market risk. This is the risk that the investment returns are going to change with respect to the changes of a broader market, right? So examples of this, things like political, economic, social events, right? All of these things are incorporated in what we refer to as being market risk. And in an earlier video, we talked about currency risk, which is, the impact on values as currency exchange rates change between two countries. So let's think about how we measure risk. Risk is measured by a statistic that's called standard deviation. And standard deviation is just an indicator of the asset's risk. It measures how the returns are spread out or how they vary. The more technical term is dispersion. Coefficient of variation is a measure of risk that looks at its relative dispersion around the asset. This is what, quite frankly, is a little bit more useful when you want to make comparisons between different assets. But if you remember our formula was it's the chance that there is a difference between the average rate of return, R bar here is the average rate of return, and the actual return that we're going to receive. This is a measure here of the historical calculation of standard deviation. So here we have a couple of assets. We have Target and American Eagle. Here are their rates of returns over the past several years. At the bottom here, you can see that the average is 7.7% for Target and 12.4% for American Eagle. Now, there is a worksheet that's available that talks about historical data returns. And in this spreadsheet, you input the returns, the historical returns. Here you can see those means, 7.7 and 12.4. But you also see the risk levels. The risk of target is 21.5%, and the risk for American Eagle Outfitters is 51%. So a question is the risk-return relationship, does it seem to fit? Well, 12.4% is obviously higher than 7.7, and it is riskier, so it looks like it is in play. But the question for an investment is, if you're trying to decide which one of these to buy, is this extra, what we have here, 4.7%, is this extra 4.7% in return, is it enough to pay for the over doubling of risk? And that question might be, in the end, it might be no. That it might just be you're not getting a high enough return based on the riskiness of the asset. We can also look at the future, right? We can look at what we expect to receive in the future. So here, R bar is the average return. Here is the probability that you're going to get a certain return, and you take the sum. That's what sigma means here. The standard deviation we talked about earlier. Here is a perfect example or illustration of our definition. What's the probability that you don't get what you expect? R bar is the expected, R sub I is what you're going to receive in a different economic outcome or event. The coefficient of variation is just the standard deviation divided by the X bar or R bar. That's just risk divided by return. So it's a relative number for us, if you will. Now we'll talk about this a lot more in later videos, and hopefully it'll become a little clearer. But if we put some examples, some assets into a spreadsheet. In this case, it's the standalone risk spreadsheet. Here we have probabilities, 25% chance of a good economy, 50% chance of 25% of a bad economy, and here we have our returns. Asset A is 20, 10, and -5. B is -2, 5, and 7. And asset C is all 4s. So if you look at the returns, the average rate of return, the expected return, asset A is 8.75%, B is 3.75%, and asset C is 4%. What is the risk of these? So if we look at standard deviation, asset A is 8.9, asset B 3.4, and look at asset C. Asset C has 0 risk. That's because no matter what happens, you get the same rate of return. If we look at the coefficient of variation, you can see that asset A, again, is higher risk than B. In a later video, we're going to talk about what happens when we start adding and creating portfolios of these assets. What happens when we combine them together? We'll save that for a later video. So if we want to assess risk, right, we need to look at the general characteristics of some alternative investments, right? We need to have some way to make comparisons, right? So the risk-return characteristics of alternative investments, we know that there's a risk-return trade-off. For higher risk, one expects higher returns. In general, low risk gets low returns. And in general, high risk, high return investments include things like real estate and other tangible kinds of assets. This recurs to common stocks, options, and futures. So we're looking at our spectrum of securities that we'll be talking about throughout these videos. If the risk-return trade-off is working properly, you can see that there is a scale, right? From the risk-free assets, as we incur, look at riskier and riskier investments. As we go up, we see that as risk increases, the returns increase. We'll actually find that in real life, in real data, the data shows that this does hold. So one other question now. How do people address risk? What do they think about it? Well, there's three ways that people could possibly look at risk. One way is to be risk indifferent or risk neutral. This basically describes an investor that really doesn't pay attention to risk at all. They just are looking at returns. Risk seeking is a person who accepts lower returns in exchange for greater risks. Now, this is really just an example of gambling. We assume that rational investors require greater returns in exchange for greater risk. And what we find out graphically is this is how their return mechanisms would work, right? Risk averse, as risk increases, they want higher rates of returns. And these folks out here are more risk averse than these folks down here. So in conclusion, right, in the steps in this decision-making process, right, when you're deciding among alternatives, you need to take the following steps to combine return and risk. You need to estimate expected returns. You then need to assess the risk of that investment by looking at its historical and/or projected returns using standard deviation. We then look at risk-return characteristics of the set of investments at our option to make sure that the returns are reasonable. And then, of course, we select those investments that offer the highest expected returns associated with the level of risk you are willing to accept. So that's the end of this video. I look forward to seeing you in the next video.